Broadcom, ticker symbol AVGO, had a stock split today, 10 for 1, meaning for every share of Broadcom, it is now 10 shares. But the stock price has been divided by 10. You can see now it is a $100 stock instead of a $1,000 stock. So the value has not changed. So is it a good time to buy Broadcom or sell Broadcom? In this video, we will analyze the data of unusual option activity, which represents the trades of wealthy investors. Are they bullish and buying Broadcom after the split, or are they bearish and selling, so that we can also trade in the same direction to make money while the rich are getting richer on Wall Street? Because as we all know, the rich have more access to information to make better financial decisions. So without further ado, let's dive into this data and then show how we are trading Broadcom based on this data. On the option time and sales tape, we can see 1,500 contracts being traded at the same time for these August 16 options at the 170 strike puts and the 170 strike calls. Now let's take a deeper look at the chain to find out more at the 170 strike calls and puts. Now notice that the open interest for every single option is 0. And that is what happens after the split, because these strike prices are much lower now because of the 10 for 1 split. And so prior hand, nobody was trading these strike prices. And that is why there is 0 open interest. And so we know that every option trade today is an opening trade. And we can see at the 170 strike calls, there were 4,000 contracts being traded at the volume. And at the put side, we had 2,000 contracts being traded. And based on our analysis, we believe that they were selling the 170 strike puts using this credit and buying the 170 strike calls. Okay? And so when we analyze this trade, you can see that this trade is a bullish long trade, because as the price of Broadcom on the x-axis goes up, you can see this is a positive gain here, these options. If it goes down, it is a negative loss, because here on the y-axis, this is the profit loss here, and 0 is the break-even line. Okay, so this is a long synthetic strategy here. And we can see that it has a positive delta, so we know that this is a bullish long trade. If it was a short bearish trade, it would be a negative delta. Now, keep in mind, because they sold the 170 strike puts, essentially saying they're willing to own 100 shares of Broadcom at this strike price. And so the buying power required to put on this trade is $17,000, selling these puts like a cash secured put. And since they did 1,500 contracts, we know that this investor needed $25.5 million. And that is why we know that this is a wealthy investor that is trading this. Okay. Now, even though this is a $25.5 million trade, because this is a very large market cap company, and because it is right after the split where many investors are repositioning their options strike prices, this is actually a lower chance of profit trade. So if you want a higher chance of profit trade, then make sure to go to our website where we share the trades of wealthy investors using this type of analysis and also our options strategies. We'll put a link at the top here where you can learn how to gain access to more of these types of trades, but with a higher chance of profit in comparison to this one here on Broadcom. Now, based on this data that is going long bullish, how did we trade Broadcom? Well, let's take a look at the chain and we can show our option strategy here. You can see we also traded the August 16 options. Our position over here at the 180 strike calls over here, POS for position, it is a green because we are buying the 180 strike calls. But we are also selling another call option over here at the 200 strike calls. You can see here, this is red because we are selling these. And so by selling these, you can see our trade strategy over here. This is a vertical call spread. Each of our trades costs $340 of debit. And you can see that over here, currently trading at 171. If Broadcom goes up, this is a positive gain profit. You can see the blue line here is our max profit. It shows up over here at expiration, $1,660 per trade. So we have a very favorable risk to reward ratio here because 1,660 is our reward divided by our risk, which is the cost of this trade, 340 of debit. You can see our risk to reward ratio is 4.8, meaning we could potentially make 488% profit. Okay, so that's one of the ways that we make sure our strategies are in our favor, but be aware of the risk of trading this type of strategy, because notice how the break even is right over here where it meets the zero profit loss line. And this share price is actually about $183 per share. So Broadcom has to trade above 183 at expiration August 16 for these options to be profitable, because it decays in value. You can see this purple line will actually drop down. And so if we are trading below 183, you can see that the blue line is actually a negative. Okay, so the risk on this option strategy is this very high theta decay of -6. Every day that goes by, these options will lose value. So be aware of this risk if you are trading options, especially this strategy. There are other strategies that we use that have a higher chance of profit because they are lower risk. If you are interested in those, then make sure to go to our website where we share the traits of wealthy investors in order to maximize profits. And that is how we are able to beat the market consistently. Let us know in the comments below, what do you think will happen to Broadcom? Do you think it will go up higher or down lower? As usual, please smash the like button, subscribe if you haven't. Take care and have a great day.